When you think about the American economy, it's 70% consumer weighted. And so as long as the consumer has jobs and the job market continues to be strong, inflation will be a challenge, but we do expect it to start to slow down as the economy slows down as a whole.
Joining me today is Jim Reilly, Managing Director, Head of Investment Grade Real Estate Debt Capital Markets with JP Securities. Jim, thanks so much for joining us.
Thanks, Matt. Good to be here.
Now, can you start by talking about your view on what the Fed will do for the rest of this year and into 2024?
Sure. So we'll find out shortly, since we'll have the Fed announcement here in the next hour or so. Our expectation at JP Morgan is that we'll get a 25 basis point increase today, which is March 22nd, and another 25. Trying to balance inflation pressures with some of the new news, so to speak, around the banking sector. To do 50 would seem to be alarmist around inflation. To do nothing would seem to be alarmist around the banking challenges in the marketplace. So we think a 25 basis point increase is the balanced kind of response, and another 25, and then the Fed will be on hold.
And how will those actions impact inflation, and where do you see that going in the next year?
So far, the Fed increases haven't impacted inflation meaningfully. We're still running kind of at a 6% run rate year over year, and that's substantially higher than the 2% target. There's a lag effect. We're starting to see from data that we have at JP Morgan from our credit card portfolio, a change in consumer spending, cash balance is coming down, higher utility, energy, housing costs running through the consumer, and so labor participation rates going up, meaning that some of the pandemic fiscal stimulus has been basically spent. And so we do expect to see some moderation. When you think about the American economy, it's 70% consumer weighted. And so as long as the consumer has jobs and the job market continues to be strong, inflation will be a challenge, but we do expect it to start to slow down as the economy slows down as a whole.
And what level of real distress do you see in some of the CMBS markets right now?
Right now the CMBS market is struggling along with all of the other asset-backed markets. So spread widening, very much a part of what's happened across all of the capital markets, whether it's investment grade, high yield, asset-backed, and other fixed income products. The challenge that the asset-backed markets have now is that the banks in question that have recently been taken over, Silicon Valley, Signature, have very large residential mortgage-backed portfolios that are being sold into the market. And so that incremental supply is creating some imbalances. At the same time, there's concern in the commercial real estate market around appraisal values, potential distress in the office market, and office is a very, very significant weight, the largest weight in the CMBS indexes. So credit caution as well as some technical imbalances in the capital markets.
And finally, do you think that's going to lead to some new price discovery so that there will be more transactions at the lower valuations?
Price discovery is definitely something that we're all interested in, especially in terms of property trading values. The institutional sales market has seen really a dearth of transactions, absent some very specific multifamily and industrial, the two strongest sectors in the eyes of most market participants. Higher cost of debt. For those that are using debt as part of the capital structure should reflect itself in lower pricing. There are all cash buyers though. I think we sometimes underestimate the strength of regional buyers, doctors, dentists, wealthy families who have faith in their local economies and will put money to work. We have been surprised to the upside around some of the secondary market financings and all cash purchases of office buildings that everyone views as very much out of favor. But local demand is still intact in some of those markets. So that's creating a bit of an underpinning in some marketplaces. But generally speaking, if we continue with a highly volatile treasury market, imbalances in the capital markets, whether it's the ABS markets or other markets, the cost of debt will be a challenge. And debt is supposed to be accretive in real estate, and right now, negative leverage is the buzzword in real estate. So either the cost of debt needs to come down longer term, or equity returns have to go up. Real estate prices have to come down.